a look there. Now, here's the deal. Here's really what's exciting about a pairs trade, or if you want to call it a spread trade, is that pairs or spreads, you can make money 5 different ways, right? So if you think about it, we'll go through the kind of scenarios. But if you're just a long short player, right, you can only make money if whatever the security you buy, you can only if you want to go long, you want that security has to go up to make money, or if you go short, you have to have that security go down. But if you have a pairs trade, you can make money 5 different ways if the value between the two are correlated enough. So let's say, for example, we were looking at Costco versus Walmart. So let's say the Costco starts to go up faster than Walmart. So it starts to move up faster, and Walmart's going up, but it's not going up as fast. So that spread is widening. See that spread widening? So, if you bought the spread here and you just had the spread long, say you bought that spread there for $100, maybe Costco is $100 over Walmart, and then that spread starts moving. Costco starts really increasing in value. Now Walmart's going up, but it's not going up as much. And now that spread is maybe $200, where now Costco is now $200 over Walmart. But it doesn't matter. But that's all you're playing is the spread, even though Walmart's going up, but more slowly. But you're playing the spread. And so these are a lot of fun as well. Or the other scenario might be where, Costco goes up, but Walmart goes totally sideways. So that's even, a better situation. So that could definitely happen. I mean, it depends on what you're, looking at. So Costco could be going up. Walmart could be going sideways. Look at that spread increasing. So maybe you started out $100 and now that spread is $300, right? So you've got $200 profit in that spread. Even if the market's going down or sideways, it doesn't matter. You're just playing that spread. You could care less about the market. You're just playing the relative strength and weakness between those two correlated instruments. Or we could have, Costco going sideways and Walmart going down. So Costco could be just going sideways and then Walmart starts going down. So now you can see that spread widening, right? So you've got that scenario. Or you could have Costco going down more slowly than Walmart. Walmart goes down faster, and Costco goes down, but it's not going down as fast as Walmart. So Costco starts going down, but Walmart really starts going down faster, and you can see that spread widening. Or the other best scenario would be if you've got Costco going up and Walmart going down, right? And then you've got that huge spread. So these things are, potential to make really big profits, but they're also, going to give you that hedge for any systemic risk. And in this kind of market environment, that's a real, that can be a real game changer for your portfolio. Now, the other really cool thing, and this is what I'll really get into more in the course, is we can do these pairs trades using synthetic options. So we can do it synthetically. So we don't have to go long the shares or short the shares. And a lot of times, if you shorted shares, you've got to basically be borrowing the shares to short. In some situations, there are not going to be any shares to short. So in the course Saturday, I'll teach you how we're going to do these pairs trades where we're long short, but we're going to, instead of being long short the equities or whatever security we want to trade, we're going to be long options and short options to replicate the exact pairs trade. Okay, so it's a really cool way to do it, and it's much more efficient. I'll go through a little bit more detail on it in a little bit. So this is going to be then mirroring the underlying stock or security you're pairing. So this is going to lower your trading costs and ends the hassle of borrowing shares to be short. So that's a